Pull out your phone right now. Open your calculator. Type in 4,550. That's what gold costs per ounce today. Now hit divide. Type in 79. That's silver. Hit equals. You're staring at 57.6. That number right there. It's not just a ratio. It's a warning signal. And what I'm about to show you will completely change how you think about your gold holdings. Because here's what nobody's telling you while they're screaming about gold breaking records every single day. That 57.6 number, it's a trap. And you're standing right in the middle of it. Let me be crystal clear. This isn't about whether gold or silver will go up. This is about the mathematical certainty of which one will go up more. And more importantly, when you should make the swap to capture that massive return. Everyone's piling into gold right now. Record highs everywhere. Central banks buying like crazy. Hedge funds loaded to the teeth. Your neighbor who's never bought an ounce of anything is suddenly asking about gold ETFs. That's classic late-stage behavior. But the numbers don't care about what everyone else is doing. The numbers care about one thing. Where is the mathematical edge? And right now, that edge is screaming at us from the gold to silver ratio. Here's why this matters so much. When gold is trading at 57.6 times the price of silver, history tells us something very specific. It tells us that silver is mathematically undervalued compared to gold. Not by a little, by a lot. But you don't have to take my word for it. Let's look at the cold, hard facts. The gold to silver ratio peaked near 40 to 1 in 1979. Then something extraordinary happened. Silver went absolutely parabolic. By January 1980, that ratio had collapsed to 16 to 1. Not 40, 16. What does that mean in actual profit terms? Silver gained 374% in 1979. Gold, 127%. Silver more than doubled gold's performance in that exact same window. The ratio compression was the mathematical signal that told you exactly where to be positioned. Now fast forward to 2011, after the financial crisis. The ratio hit 84 to 1 in 2008. Everyone was terrified. Gold was the safe haven trade everyone wanted. But if you were watching the ratio, you saw something different. You saw the setup. By April 2011, that ratio had collapsed to 31 to 1. And silver, it absolutely rocketed 391% from its 2008 low to its 2011 peak, from $8.79 to $48.70. Gold gained 157% in that same period. Solid, respectable. But silver gave you 2.5 times gold's return. Why? Because when the ratio is elevated, when silver is deeply undervalued relative to gold, the reversion is violent. It's not linear. It's explosive. And what I'm about to show you next will prove that we're sitting on the edge of another one of these explosions. Here's the part that should make your ears ring. When the gold to silver ratio exceeds 70, and we're sitting at 57.6 right now, the subsequent 24-month returns for silver average 147%. Gold? 34%. This isn't theory. This is historical pattern recognition. The ratio above 70 is the mathematical setup for silver to outperform gold by a factor of 4 to 1. So why is gold at 57.6 times silver right now? Because gold is overbought. Technically, fundamentally, psychologically. It's in bubble formation territory. Let me show you the technical data that nobody wants to talk about because it ruins the gold party narrative. Gold's daily relative strength index is 84.6. For those who don't trade, RSI above 70 means overbought. We're at 84. But that's not the scary number. The monthly RSI for gold is 91.3. 91.3. That is the highest monthly RSI reading for gold since 1980, higher than 2008, higher than 2020. This is a 45-year extreme. And here's what the data tells us about RSI readings above 90. They are rarely sustainable beyond 3 to 4 months. The snapback is brutal. Now let's talk Bollinger Bands. Gold is currently trading $180 to $240 above its upper Bollinger Band. The 20-day simple moving average for gold is 4,310. The upper band is 4,490. Gold is at 4,550. That's not just extended, that's parabolic. And the bandwidth has expanded 38% in 30 days. You know what that signals? Volatility climax, the kind that comes before 8 to 12% corrections. Statistical probability, 95% of the time when gold exceeds its upper Bollinger Band by more than 4%, it mean reverts within 20 trading days. We're not talking about maybe, we're talking about mathematical probability, so gold is technically exhausted. But what about the fundamental demand? What about central banks? Aren't they the unstoppable force buying gold at any price? Let's check the actual numbers. Poland, the largest central bank gold buyer in 2025. They purchased 82.7 tons from January through October, Aggressive accumulation, right? But here's the data point everyone missed. Poland stopped buying in May. They announced a 30% gold allocation target, and then they went quiet. Why? Because at $4,500 an ounce, their strategic target is reached. The marginal demand from Poland is done. China. The People's Bank of China bought gold for 18 consecutive months through Q3 2025. Relentless accumulation. The market loved this narrative, but look at the recent pace. August 2025, 2 tons. That's it. Over 9 months, they've added 36 tons total. Compare that to 155 tons in 2023. China's gold buying has collapsed by 77% year over year. And the PBOC is now publicly stating they're emphasizing quality over quantity in reserve management. Translation: they're done chasing gold at these levels. But what happened next with Singapore will absolutely shock you. Singapore went the other direction. They sold 15.24 tons in 2025. Profit taking after 49 months of accumulation. They're cashing out at record highs. Net result across all central banks: 254 tons of net purchases from January through October 2025. That's down 62% versus the 2024 pace. The central bank demand is fading, not because they don't want gold, because gold is expensive, prohibitively expensive, and central banks are value buyers, not momentum chasers. So we have technical exhaustion, we have fundamental demand rolling over, and we have a gold to silver ratio sitting at a level that historically comes before violent outperformance by silver. But here's where it gets really interesting. This isn't just about gold being overbought. This is about silver being underowned, undersupplied, and about to enter a supply shock that will make 2011 look tame. Because while everyone's watching gold hit new records, something is happening in the physical silver market that is absolutely extraordinary. And it starts on January 1st, 2026, 29 days from now. But before I show you the supply shock data, you need to understand the rotation math. Because this is where the asymmetric opportunity lives. Let's say you own 10 ounces of gold right now. At $4,550 per ounce, that's $45,500 of value. If you sell that gold today and rotate into silver at $79 per ounce, you can buy 576 ounces of silver. That's your swap position. Now let's run 3 scenarios. Pay very close attention to the profit differential. Scenario A, silver outperforms. This is the most probable outcome based on historical ratio compression patterns. Gold rises modestly to $5,000 per ounce. That's a 9.9% gain. Solid. Respectable. But the gold to silver ratio compresses back to its historical mean of 30-1. That means silver rises to $167 per ounce. That's a 111% gain. If you held your 10 ounces of gold, you made $4,500. If you rotated into 576 ounces of silver, you made $5,500. The rotation gave you $46,000 more profit. That's a 10 times better return than staying in gold. Scenario B, gold corrects. This is the defensive case for why you rotate. Gold falls to $3,800 per ounce, a 16.5% correction. Painful if you're holding gold. Silver holds at $79 because industrial demand provides a floor. The ratio widens to 48-1 temporarily. If you held gold, you lost $7,500. If you rotated into silver, you lost $0. You preserved your capital while gold holders got crushed. Scenario C, parabolic silver. This is the supply shock scenario. China's export ban triggers a 200% spike in silver to $237 per ounce. Gold rises to $5,500. The ratio compresses to 23-1. Your 576 ounces of silver are now worth $136,512. You turned $45,000 into $136,000, a 200% return. Gold gave you 20.9%. You outperformed gold by a factor of 9.6. And what's about to happen with China will make this scenario look conservative. This is not speculation. This is scenario analysis using historical ratio behavior and current supply dynamics. The probability-weighted expected value of rotating from gold into silver right now is overwhelmingly positive. And that's before we even factor in what's about to happen to the physical silver market. Because here's what you need to understand about silver versus gold. Gold is a monetary metal. Its value is driven by fear, by central bank policy, by safe haven demand. It's psychological. Silver is different. 59% of silver demand is industrial. Solar panels, electric vehicles, electronics, 5G infrastructure. These are non-negotiable consumption patterns. You can't print silver. You can't create it with monetary policy. And you can't substitute it in most applications. Gold is 8% industrial. It's a store of value. Silver is a strategic commodity that also happens to be money. and that industrial demand profile is about to create a supply crisis that will make silver unobtainium. 29 days from now, the global silver market is about to experience a structural break that will make the nickel squeeze of 2022 look like a warm-up act. Let me start with the headline that should be on every financial news network but isn't. China is implementing license-based export controls on silver effective January 1st, 2026. If you don't understand what that means, let me translate it into plain English. China is about to remove 60 to 70% of the world's tradable silver supply from the global market. Not reduce it, remove it. Here's how it works. Starting January 1st, any Chinese company that wants to export silver will need a government-issued license. And to qualify for that license, you need to produce more than 80 tons of silver per year and have a $30 million credit line. How many silver producers in China meet that threshold? A handful. Maybe 10 companies out of hundreds. China controls 65% of global refined silver output. And they're about to put 90% of their producers out of the export business. This isn't a trade war tariff. This isn't a temporary policy. This is strategic resource control. And the market is already reacting. Shanghai premiums are spiking, $8 to $15 per ounce over COMEX prices. That's not normal. That's panic. That's buyers in Asia scrambling to lock in physical metal before the export window slams shut. Now let me show you why this matters so much. Because it's not just about China. It's about what happens when you remove 70% of supply from a market that is already running a massive deficit. The global silver market is projected to run a physical deficit of 118 million ounces in 2025. Last year it was 87 million ounces. We're talking about a 36% increase in the shortage. And that's before the China export ban. When you remove 60 to 70% of tradable supply from a market already short 118 million ounces, you don't get a price increase. You get a price explosion. But what's happening at the COMEX right now is even more terrifying. It gets worse, because while China is choking off supply, the COMEX is about to experience something that commodity traders have nightmares about. An inventory death spiral. Let me give you the numbers. As of December 24th, 2025, COMEX registered silver inventory sits at 28.4 million ounces. That's below the critical 30 million ounce threshold. And if you know anything about commodity exchanges, you know that when registered inventory falls below minimum operational levels, the exchange loses its ability to function as a price discovery mechanism. Translation, COMEX stops being a paper market and becomes a physical delivery battleground. And here's the truly insane part. In late November, 60% of COMEX registered inventory was claimed for physical delivery in just 4 trading days. 4 trading days. That's not normal market behavior. That's a run on the warehouse. That's industrial users and large buyers realizing that paper contracts are worthless if there's no metal behind them. Now some of you might be thinking, okay, inventories are low, but can't they just get more silver from the mines? Can't production ramp up? No. And here's why. Silver mine production has declined 7% since 2016. Gold production in that same period, up 12%. Silver is primarily a byproduct of base metal mining, copper, lead, zinc. You don't just open a silver mine because prices are high. The geology doesn't work that way. And the base metal markets aren't incentivizing increased production right now. Supply is inelastic. Demand is accelerating. And the largest supplier just announced they're cutting exports by 70%. This is the setup for a commodity supercycle. And we're watching it happen in real time. But if you want proof that this isn't just theoretical, if you want evidence that the physical shortage is already here, you need to understand backwardation. For those who aren't commodity traders, let me explain what backwardation means. Normally, in a well-functioning commodity market, the futures price is higher than the spot price. That's called contango. It reflects storage costs and the time value of money. When that flips, when the spot price is higher than the futures price, that's backwardation. And it means one thing. People need the physical metal right now. They're willing to pay more for immediate delivery than for a contract 3 months or 6 months out. Backwardation is the market screaming there's a shortage. And silver is in backwardation right now, not just in one market, in multiple markets simultaneously. Let's start with Shanghai. The Shanghai Gold Exchange is showing spot silver at $78.49 per ounce. 3-month futures, $73.20. That's a $5.29 backwardation. The spot price is 7.2% higher than the futures price. That is a massive inversion. But it's not just the futures curve. Physical silver in Shanghai is trading at an $8 to $10 premium over the London fix. Think about that. Chinese buyers are paying $10 more per ounce than the global benchmark price just to secure immediate delivery. And Shanghai vault inventories, 531,211 kilograms. That's the lowest level since 2015, down 73% year over year. China is running out of silver, and they know it. That's why the export ban is coming. But what's happening in London will absolutely blow your mind. Now let's look at London. The London bullion market is showing the same pattern, spot at $81.50. 6-month forward at $73.80. That's a 7.9% annualized backwardation. And here's the kicker. Silver lease rates in London spiked to 32% annualized in October. They've stabilized now at 8 to 12%, but that's still historically elevated. What does a 32% lease rate mean? It means that holders of physical silver are demanding a massive premium to lend their metal because they don't believe they'll be able to get it back, or they don't believe the borrower can actually deliver physical metal. This is not normal market behavior. This is a physical shortage manifesting in the financial plumbing of the silver market. When you see backwardation in Shanghai and London simultaneously, when you see lease rates at levels that indicate physical unavailability, when you see premiums spiking and inventories collapsing, you're not looking at a potential shortage. You're looking at a shortage that's already here. Now here's where this gets interesting for the gold to silver rotation trade. Because silver isn't just undervalued relative to gold based on the ratio. Silver is about to become unobtainium based on physical availability. And when a commodity goes from undervalued to unobtainable, the price action is not linear, it's vertical. Let me give you a comparison. In 2021, nickel was trading around $18,000 per ton. Then Russia invaded Ukraine. Nickel supply from Russia got cut off. The London Metal Exchange had a short squeeze. Nickel spiked to $100,000 per ton in 2 days. That's a 550% gain in 48 hours. Now, I'm not saying silver is going to do that, but I am saying that when you combine a supply shock with a structural deficit and backwardated physical markets, the upside is not capped by normal valuation metrics. It's capped by availability, and availability is disappearing. Here's the other factor nobody's talking about. Industrial demand for silver is non-discretionary. Solar panel manufacturers need silver. They can't substitute it. They can't reduce consumption. They have production contracts. They have orders to fill. If silver goes to $150 an ounce, they don't stop buying. They pay $150. Electric vehicle manufacturers need silver for battery management systems and charging infrastructure. Non-negotiable. 5G networks need silver for circuit boards and antennas. Non-negotiable. This is not like gold, where demand is elastic and price sensitive. This is like copper or lithium. You need it or your production line shuts down. And that industrial demand is about to collide head-on with a Chinese export ban and a COMEX inventory crisis. The result? Price discovery is going to break. Now let's talk about what this means for the rotation trade, because the supply shock doesn't just make silver attractive, it makes the timing of the rotation urgent. If you rotate from gold to silver today, you're buying silver at $79 with a 57.6 gold to silver ratio. That's the entry point. If you wait 30 days and the China export ban kicks in and the market starts pricing in the supply shock, you might be buying silver at 110 or 130 or who knows what. And the window to act is closing faster than anyone realizes. The edge in this trade isn't just the ratio compression, it's the timing of entry before the supply shock gets priced in. And here's the beautiful part. Even if gold corrects, which is highly probable given the technical setup we covered earlier, silver has a floor. Industrial buyers need silver. They're going to bid for it regardless of what gold does. The backwardation proves that demand for physical silver is inelastic at current prices. So you're rotating out of an overbought, technically exhausted, momentum-driven asset with fading central bank support. And you're rotating into a supply-constrained, industrially critical, backwardated commodity on the verge of a major supply disruption. This isn't a trade. This is a structural mismatch that the market hasn't priced in yet, and the clock is ticking. 29 days until January the 1st. Let me give you one more data point that should make this crystal clear. Remember I told you about that 60% of COMEX registered inventory being claimed in 4 days? Here's what happened after that. COMEX inventories dropped below 28.4 million ounces, and they haven't recovered. Every week more claims, every week less metal. At the current rate of withdrawal, COMEX will hit critical inventory levels by late January or early February, right when the China export ban starts to bite. And what happens when COMEX can't fulfill delivery obligations? Either they cash settle, which destroys confidence in the paper market, or they have to source physical metal at any price, which sends the spot price vertical. Either way, silver disconnects from the paper market and trades based on physical availability. And physical availability is about to vanish. This is not a drill. This is not a maybe. This is happening right now in the inventory data, in the backwardation curves, in the Shanghai premiums, in the export policy announcements. The market just hasn't figured it out yet. Because everyone's staring at gold hitting new all-time highs every day, they're not watching the silver inventories, they're not tracking the Chinese export licensing requirements, they're not calculating the deficit math, but you are, because you're watching the numbers, and the numbers are showing you exactly where the asymmetric opportunity is. Gold is the crowded trade, silver is the unobtainium trade, gold is overbought, silver is underowned and undersupplied, gold's technical and fundamental support is fading, silver's industrial demand floor is non-negotiable. The gold to silver ratio is at a level that historically comes before massive silver outperformance. And we're 29 days away from a supply shock that will accelerate that ratio compression violently. The supply shock is real. The inventory crisis is real, the China export ban is real, and the clock is running. Now let me show you exactly how to execute this rotation, what the risks are, why silver is strategically safer than gold from a confiscation standpoint, and what the roadmap looks like over the next 6 to 12 months. You've seen the math. You've seen the supply shock data. Now let's talk about how you actually do this rotation. But first, you need to know something about execution that could save you thousands. If you own physical gold, the rotation is straightforward. You sell your gold coins or bars to a reputable dealer. You take that cash and immediately buy physical silver. Same day, if possible. You do not want to sit in cash and wait for a dip. The entire thesis here is that you're capturing the ratio arbitrage before the supply shock gets priced in. If you own gold ETFs like GLD, you sell your shares and rotate into silver ETFs like SLV or PSLV. PSLV is preferable because it's backed by allocated physical silver in Canadian vaults. SLV is unallocated and has some counterparty risk, but it's liquid. If you own gold mining stocks, this gets more nuanced. You could rotate into silver miners like First Majestic or Pan American Silver, but understand that miners have operational leverage and bankruptcy risk. They're not the same as owning the metal. For this rotation trade, I'm focused on physical or physically backed positions. Now here's the key tactical point. You want to execute this rotation in size. Not 10% of your gold position, not 20%. If you believe the thesis, you go full rotation. Why? Because the asymmetric payoff only works if you're positioned for the ratio compression. If you hold 50% gold and 50% silver and the ratio compresses, you made some money. But you left the majority of the edge on the table. The math we showed you earlier assumes you rotate fully. 10 ounces of gold into 576 ounces of silver. That's how you capture the 10-to-1 profit differential. Half measures don't capture asymmetric returns. Now let's talk about risks, because every trade has risks and you need to know what could go wrong. Risk number 1, the ratio doesn't compress. Gold and silver both go up, but the ratio stays at 60 or 70 to 1. You still made money on silver, but you didn't capture the outperformance. This is the opportunity cost risk. Probability? Low. Historically, when the ratio exceeds 70, mean reversion happens within 12 to 24 months, and with the supply shock coming, the catalyst for compression is in place. Risk number 2, silver crashes. Some deflationary event, a global recession. Industrial demand collapses and silver falls harder than gold. This is the real risk. Silver has a beta of 1.5 to 2.5 relative to gold. It moves faster in both directions. If there's a major risk-off event, silver could drop 20 to 30%, while gold only drops 10%. How do you hedge this? You don't rotate your entire net worth. You rotate your gold position. If you're holding gold as a hedge and you rotate it into silver, you're still in precious metals. You're still protected against currency debasement. You're just taking more volatility for more upside. But if you need liquidity or if you're worried about a deflationary shock, you keep some dry powder in cash or short-term treasuries. You don't go all in on any single trade. Risk number 3, physical delivery issues. You buy silver, but the dealer can't deliver. Or delivery takes months. But what nobody's telling you about government confiscation risk will completely change your perspective. You get caught in the supply crunch and you're sitting in cash waiting for metal that never shows up. This is why timing matters. If you wait until March when the China export ban has been in effect for 3 months, good luck finding physical silver at anywhere near spot price. Premiums could be 20, 30, 40% over spot. You execute this rotation now, December, early January at the latest, before the shortage becomes obvious to the market. Risk number 4, government confiscation or windfall taxes. Now this is where it gets interesting, because this is actually an argument for silver, not against it. Let's talk about the confiscation risk for gold versus silver, and let's be very clear about the history here. Executive Order 6102. The U.S. government confiscated gold from private citizens. You were required to turn in your gold coins and bullion in exchange for paper dollars at $20.67 per ounce. Then the government immediately revalued gold to $35 per ounce. Instant 20% devaluation of your purchasing power. That happened. It's historical fact. And the justification was that gold was a monetary metal critical to the functioning of the financial system. Silver? Never confiscated. Why? Because silver was an industrial metal. It was needed for manufacturing, for photography, for electronics. The government couldn't seize industrial commodities without shutting down the economy. Now fast forward to today. Silver is 59% industrial demand. It's critical for solar panels, electric vehicles, 5G, medical devices. It's a strategic commodity. Gold is 8% industrial. It's primarily a monetary asset and a store of value. If there's another financial crisis, if the government decides it needs to control monetary metals to stabilize the currency, which one are they going to target? The monetary metal, gold. Silver has industrial utility that makes it strategically untouchable. You can't confiscate the metal that's needed for national defense electronics and renewable energy infrastructure. This is not a small point. If you're worried about government overreach, if you're worried about capital controls, if you're worried about wealth confiscation, silver is the safer metal to hold. Now let's address the windfall tax question. India discussed a 20% windfall tax on gold profits above a certain threshold. It was tabled because of jewelry industry lobbying, but the fact that it was even discussed tells you where government thinking is headed. When assets hit record highs and politicians need revenue, they start talking about windfall taxes. Gold at $4,500 and climbing, that's a target. Silver at $79 with low public ownership, nobody's even thinking about taxing silver. It's not on the radar. Could that change if silver goes to $200? Maybe. But by then you've already captured your 200% return and you can deal with the tax consequences. The point is, right now, silver is under the political radar in a way that gold is not. So you've got less confiscation risk and less windfall tax risk with silver. That's a strategic advantage that nobody's pricing in. Now let me show you the exact roadmap of what happens over the next 12 months. January 1st, China export ban takes effect. We should see immediate tightness in Asian markets. Shanghai premiums widen further. Lease rates spike if they haven't already, January through February. COMEX inventories continue to decline. At some point, probably late January or early February, we hit a critical threshold where industrial buyers panic about securing supply. This is when backwardation intensifies and spot prices start to disconnect from futures. March through April, the market fully prices in the supply shock. Silver breaks through $100. The financial media finally notices. Retail buyers start piling in. The gold to silver ratio starts compressing rapidly, May through August. Ratio compression accelerates. We move from 60 to 1 down toward 40 to 1. Silver is outperforming gold by a factor of 3 or 4 to 1. The trade is working exactly as the math predicted. September through December 2026, we're in full-blown silver mania. The ratio hits 30 to 1 or lower. Silver is at $150 to $200, depending on how severe the supply shortage gets. This is when you start thinking about taking profits. That's the roadmap. 12 months, January to December 2026. Does it play out exactly like that? Maybe not. Markets are unpredictable, but the structural forces are in place. The supply shock is real, the inventory deficit is real, the ratio is historically elevated, the setup is there. All we're doing is positioning for the highest probability outcome based on the data. Now here's my final point, and this is important. This rotation trade is not about being a gold bear or a silver bull. It's about relative value. It's about recognizing that gold has had its run and is technically exhausted while silver is coiled and about to enter a supply crisis. Gold could still go to $5,000 or $5,500. I'm not saying gold crashes to zero. I'm saying silver goes up more. And the math is undeniable. If you rotate 10 ounces of gold into 576 ounces of silver and the ratio compresses to 30 to 1, you don't care what the absolute price of gold is. You care about the ratio. Because that's where your profit comes from. This is arbitrage thinking. This is ledger thinking. You're not making a directional bet. You're exploiting a mathematical mismatch. And the timing is now, not next month. Not after the export ban kicks in. Not after COMEX inventories hit zero. Now. Because by the time this trade becomes obvious to everyone else, the entry point will be gone. You'll be buying silver at $120 when you could have bought it at $79. The edge in trading is not being right. It's being early. And right now you have the data to be early. Look at your portfolio. Look at your gold position. And ask yourself one question. Do I want to hold the asset that's overbought at a 45-year technical extreme with fading central bank support? Or do I want to hold the asset that is entering a supply shock with inelastic industrial demand and a gold to silver ratio that's screaming undervaluation? The numbers are giving you the answer.